Hey there, and welcome to This Explainer. Today, we're tackling what is honestly the ultimate modern dream, escaping the relentless 9 to 5 grind. We're breaking down the new retirement and demystifying this whole idea of financial independence. If you've ever felt like waiting decades for a calmer for your life just seems totally unfair, well, you're in exactly the right place. We're going to explore the modern financial strategies actually designed to give you your time back. So let me just ask you a question right off the bat. Is life without a paycheck actually possible? I mean, we've all been conditioned to believe that relying entirely on a traditional, continuous salary is literally the only way to navigate modern life. But when you look at the data and the new strategies emerging out there today, it's pretty clear that it's absolutely not the only way to live. But to get there, we first need to define exactly what we mean by financial independence. Basically, it's the stage where your passive income and assets cover all of your living expenses. We're grounding this dream in a concrete financial state, not just some abstract pie-in-the-sky concept. It simply means your money is doing the heavy lifting for you, whether that's through interest, dividends, or rent, so you no longer have to depend on an employer just to survive. Okay, so here's our roadmap for this explainer. 1. Life without a paycheck. 2. Habits for financial freedom. 3. The barista fire strategy. 4. The geo arbitrage advantage. And finally, 5. Risks and reality checks. Let's just dive right in. Section 1, Life without a paycheck, escaping the traditional salary. So before you can design this brand new life, you've got to figure out your baseline survival. The absolute crucial starting point is this incredibly simple mathematical formula. It reveals exactly how long your current net worth can actually sustain your lifestyle. You just take your assets, subtract your liabilities, and then divide that number by your monthly expenses. And boom, that gives you the exact number of months you can survive without a single paycheck. It's just a brilliantly straightforward way to see exactly where you stand today. Moving on to Section 2, Habits for Financial Freedom, the non-negotiable foundation. Look, surviving without a salary requires some serious preparation. Financial independence isn't some magic one-time trick. It's a continuous process. You have to master these disciplines before you can even think about alternative retirement strategies. Let's quickly run through these 5 core habits. First up, strict expense management. You've got to draw a really clear line between your needs and your wants. Second, building passive income streams so your money's working around the clock for you. Third, consistent early investments because listen, time in the market is way more important than timing the market. Fourth, getting protection plans like life and health insurance to guard against sudden financial losses. And finally, you absolutely need a 3 to 6 month liquid emergency fund to handle those out-of-nowhere shocks like a job loss or a medical emergency. Now, if you're looking for a really specific target to aim for as you build these habits, zero in on this number, 20%. Setting a goal to save 20% of your annual income is essentially the golden rule for building your freedom runway. Making this savings rate automatic is how you basically guarantee that you're consistently paying your future self first. All right, Section 3, the barista fire strategy, a hybrid approach to early retirement. Now we're shifting gears to our first modern hybrid strategy for early retirement. What's super cool about this approach is it offers a much gentler shift away from traditional full-time work. And the best part, it doesn't require you to quit working entirely. Just look at the difference between these 2 popular strategies from the FIRE, or Financial Independence Retire Early movement. Over on the left, we have Barista Fire. This means you're supplementing modest withdrawals from your savings with a low-stress part-time job to help cover your day-to-day living costs. Contrast that with Coast Fire on the right. That means you already have enough invested right now that it's going to grow to your full retirement scale all on its own without you touching it or even adding to it today. So Barista Fire is all about stepping back right now, while Coast Fire is about letting your investments do all the heavy lifting for the future. And this right here brilliantly illustrates that Barista Fire math in action. Let's say your total yearly living costs are $40,000. Now, by working a part-time job, maybe a consulting gig, freelance writing, or literally just working in a local cafe, you bring in $18,000. Well, that means you only need to withdraw $22,000 from your actual investments. That part-time income drastically reduces the pressure on your portfolio, giving the rest of your money way more time to sit back and compound in the background. So, you want to calculate your own Barista Fire target number. It literally just takes these 3 simple steps. First, estimate your total annual living expenses. Second, subtract whatever income you realistically expect to earn from your part-time work. And third, take that remaining gap and apply a safe withdrawal rate to figure out the total investment portfolio size you'll need to actually sustain that lifestyle. Okay, so what exactly is a safe withdrawal rate? Well, you'll hear a lot of talk about the 4% rule. This is a super famous, kind of rigid historical guideline that suggests you withdraw 4% of your total portfolio in year one, and then just adjust that dollar amount for inflation every year after that. But hey, a quick word of caution here. This rule assumes some incredibly rigid spending habits and relies on historical market returns that might not actually fit your personal life or future market realities. It is a fantastic starting point for sure, but you really shouldn't just blindly follow it through the letter. Which brings us to Section 4, the geo-arbitrage advantage. Location independence as a financial tool. Let's transition to the second major lifestyle strategy, which is all about geographic flexibility. I absolutely love this quote from our sources. Imagine sipping coffee in a cozy cafe in Mexico City while your paycheck is set at San Francisco's cost of living. Just pause and picture that for a second. It's such a vivid, evocative image, right? Working remotely from this vibrant, culturally rich, low-cost city, all while still bringing in a high-tier salary. And that is the core mechanism of geo-arbitrage. You are intentionally taking advantage of the massive gap between high-income earning and low-cost living. Because remote work allows you to earn your money in a strong currency market, you can then choose to live in a destination where your everyday expenses, stuff like housing, food, and healthcare, are literally just a fraction of the cost. This setup effectively lets you supercharge your savings rate and buy a significantly higher quality of life, but for way less money. It's a real game changer. All right, moving into our final section, Section 5, Risks and Reality Checks, the fine print of the new retirement. Look, as incredible as these lifestyle designs sound, and they really are amazing, they do come with some real-world vulnerabilities that you absolutely have to manage. Let's just rapid fire through the major risks of a hybrid retirement. First off, part-time hours or gig income, they can be highly unpredictable. Second, stepping back from a traditional job often means saying goodbye to employer-sponsored healthcare, paid leave, and pension credits. Third, inflation can easily outpace a part-time salary, which can really squeeze your budget. Fourth, if you happen to hit a market downturn early in your semi-retirement, your investment returns might fall short, putting a lot of pressure on your portfolio. And finally, please don't underestimate the emotional uncertainty of leaving a structured career behind. Semi-retirement requires adapting to a completely new rhythm and, honestly, a new identity. And tying back to that withdrawal rate we discussed earlier, your actual rate shouldn't just be that blind 4% rule. It needs to be highly personalized. Notice how the suggested initial withdrawal rate shifts based on your specific planning time horizon and your asset allocation. For instance, if you need your portfolio to last 30 years with a moderate allocation, you're looking at something around 4.2% to 4.8%. But if you only have a 10-year horizon with a conservative allocation, you could potentially withdraw upwards of 10.6% to 10.9%. The huge takeaway here is flexibility. You absolutely must adjust your plan based on real market conditions and your actual lifespan. Which brings us to our final and definitely most important question. Is the new retirement actually right for you? Over the course of this explainer, we've looked at the mechanics, from strict savings habits to the part-time buffers of barista fire, all the way to the global leverage of geo-arbitrage. But ultimately, you have to look inward and ask if the incredible freedoms of this lifestyle are truly worth the trade-offs, the unpredictability, and the intense discipline it demands. It is a completely different way to design your life. So the real question isn't just whether you can afford to retire early, it's whether you're brave enough to totally redefine what work actually means to you. Are you ready to take your time back? Thanks so much for joining me on this explainer, and keep learning.